Okay, so I'll officially kick off. Welcome you all tonight for attending the Self-Managed Super Fund Basics meeting. I appreciate you all taking the time to be with us this evening. I know everybody is busy during the week and even probably as busy, if not more busy, on the weekend. We hope the evening will be informative and there'll be information that you'll be able to take away tonight. As a financial advisor, I do see a lot of clients have a lot of information that they know or common questions that's asked. So we thought that having a medium like this to be able to discuss those questions would be a good idea. And we will have opportunity for around 5 questions or so at the end. So essentially, if everybody's question is not answered, all of our contact details will be provided, and we'll try and follow up with everyone to go over any questions or queries they have from tonight. Okay, so I already discussed the general advice warning for those people joining on, that we are not taking anyone's personal situations or objectives into circumstances, and that please seek professional advice before making any decisions for your circumstances. Okay. So who we have tonight is myself as a financial advisor. I'm based in Melbourne, run GTM Finance as a financial advisor. We also have my wife, Modupe Oyekanmi, as a mortgage broker, who's running our own mortgage broking business and things related to finance. And we have Simon Hand as part of Udo SMSF, who's a self-managed super fund administration specialist that helps with the compliance and the tax compliance of the obligations for self-managed super funds. Great. So a bit about me. I have different qualifications within financial planning, Master of Finance degree, taken the specialist SMSF specialist course, and also a Diploma of Financial Planning and bachelor's degree. So what is a self-managed super fund? Self-managed super fund is where people can invest their superannuation self-managed, just as the title explains. The other main super funds are industry funds that most people have from their employer, which is funds like CBUS, Australian Super, Coast Plus, and the like. There are also retail funds, which give you a few more options than you get with industry funds, as far as you can get more than the pre-selected options of defensive, balanced growth, high growth. With retail funds, which can also be called wrap products, you can also invest in direct shares, in managed funds, and more unlisted investments, which gives people a little bit more control than what they receive with industry funds. And then thirdly, you also have self-managed super funds. All right. So self-managed super funds let you have even more ownership and let you do things like purchasing property for investments, let you purchase shares in businesses, let you buy commodities, other unlisted asset investments that just gives you more control. Okay. So today's focus is the ingredients that set up a self-managed super fund. Talking on the investment strategies, the workings of a SMSF, including the bank account, eligible assets, conditions of releases, and trustee structures. Okay, so next page. So you have 2 options with self-managed super funds. You're either set up as an individual trustee or a corporate trustee. Individual trustees only allow you to have 2 members, whereas a corporate trustee can let you have up to 6 members, which effectively can reduce costs because the administration of the tax return that's done every year and the audit that's done every year is done on the behalf of the whole fund. So right now, if you have 6 people who have individual supers with $100,000 each, for an example, they may each be paying $500, which would be $3,000 a year. Some people may be able to get the SMSF totally done for less than that, which can potentially give some savings. And depending on the size of people's balance, the complexity of the investments they're looking at, and also the goals of the self-managed super fund will help them determine if they should set an SMSF up. And then if you have an SMSF set up or you're setting one up, Depending on how many people you want to have join the self-managed super fund will determine if an individual trustee or a corporate trustee is right for you. You can add extra members to a corporate trustee. Then at the start, you have a little bit less flexibility in regards to the changing of trustees when it's an individual trustee, which Simon will touch on a little later on. The two main items that come with the SMSF when the construction is a trustee and the investment strategy. The trustee is essentially outlines the fund's rules, the responsibilities and members' rights. So just like a company constitution, you actually can change what's within there. So you can, it also has information on like how people can exit the fund at the end, if people can exit, if people can join. So essentially you want to tailor it to what you have in mind, right? Because you don't want to have some things that's restricting you, or likewise, you don't want things that is too flexible or would not let you have the control that you're looking for. It also ensures compliance with regulations, guides, and fund operations. Okay. The second portion, like I mentioned, the trustee is the first big major portion of the SMSF. The second portion is the investment strategy. Usually, us financial advisors will provide a statement of advice that would go over a client's situation to determine if a self-managed super fund is relevant for them, and also would go over the cash flow and pros and cons of each of the different investments they're considering. We also have a risk profile. So risk profile means the types of investments that somebody should go into, pending how much they can tolerate risk. Risk profile can vary due to age, can vary due to the amount in super, and most likely can vary due to the risk someone's willing to take on. So someone who doesn't want an asset or an investment to fluctuate more than, let's say, 10%, should not have too much of their investments in the share market or stock market. And that's because the stock market is known to have a negative return every 7 years. It's also known to be very volatile and can drop more than 20%. So the last thing we want is a client to be stressed out or be in an investment that fits outside their risk tolerance. Therefore, advisors make a risk profile to assist the clients in being in investments that's suited for what they're looking to invest in. There's also the asset allocation, so how much percentages they should be invested in, whether that's in shares, bonds, term deposits, private equity, credit funds, debt funds. And this investment strategy can be regularly reviewed to make sure that it's aligned with the client's current situation. Because how a 30-year-old would invest today, who's started their career and maybe still just growing their funds aggressively, would be investing considerably different to a retiree who now isn't working anymore and they want to preserve their capital. So really understanding where they are in their journey, what they're looking to achieve, will help advisors and professionals give advice or give information on how that should be allocated. Once a self-managed super fund is set up, there will be a SMSF bank account, which is where the funds will be deployed to or rolled over from their initial retail or industry fund. It's from the bank account that all of the separate investments will now be allocated to. So if they are investing in shares, then from the bank account, the money will go over to the broker account, then the shares will be invested. If they are purchasing property, then the deposit will be paid from the bank accounts. Likewise for the property, likewise the rent will be received inside the bank accounts, and essentially the bank account is the original point of all flows of funds coming in and out. Manages contributions from work as well, and also expenses. So best practices is using bank accounts that maintain clear records, and accounting practices that's going to be used for the accountants when it comes to the SMSF tax return that's done annually. I haven't even touched on that yet, which some will go more in depth on, but one distinct difference from self-managed super funds, retail funds, and industry funds is you do have to have a tax return every single year. You also do have to have an audit from the tax return that was done by the accountants of the self-managed super fund. You do not need to have a tax return done on your own behalf with a retail fund or industry fund. It is being done, but it's done by the trustees of the retail or industry fund. So you, as you being the trustee of your self-managed super fund, that obligation now lies with you, and you are able to get professional help such as accountants and self-managed super fund administrations teams to do that tax return on your behalf. Okay, so that's a keynote to touch on. Okay, so to quickly touch on some eligible assets for self-managed super funds. We have people can buy residential investment property, commercial investment properties. There is a work exception, business exception rule of where people are able to use commercial property for themselves while they're still working. All other investments in super cannot be assessed or used until you've met a condition of release, right? Condition of release means you've retired, you've left the country permanently, compassionate grounds, etc. But while you're working, if you haven't met a condition of release, you cannot access any of your super except for the business exception rule. The law may change, but as of right now, Simon can correct me, I do believe that's the only asset, only way you can access your super now is through commercial business purposes. And there are specific rules and percentages people can use or contribute towards that, etc. So there is more information to understand about that. It's not as simple as just buying one and start using it straight away. People can also buy shares and units in public and private companies. So if there's a great IPO, great private business that is selling units of percentage of the business, self-managed super funds are accessible to that. A lot of questions people ask me is once they've got the property or they've got some units in a business, can they now use that money? The answer to that is no, they cannot, not until they've met a condition of release. All profits or all business growth that is being obtained from those units in the investment is still solely going to be enclosed to the self-managed super fund. Again, so I just want to reiterate that, no access to the funds until you met a condition of release. What are some of the benefits of being able to invest in these assets individually as opposed to through a retail industry fund? Is you do get more diversification, and there are some potential really large capital gains advantages that can happen once people have retired, which they may not have the same access to if they're just in a traditional industry fund or a retail fund. In addition to the eligible SMSF assets, insurance is an important aspect of your super. People take personal insurances to cover them for loss of income due to sickness or injury. There is life cover, there's total permanent disability, trauma cover, and income protection. Most superannuation funds provide clients with some portion of default cover once they become members of an industry fund. However, once you close your industry fund or retail fund and you roll over to an SMSF, unless you keep a small balance there, you will lose that insurance. So ASIC does recommend people to assess or speak with a financial advisor to assess what insurance would be appropriate for them going forth once you've lost your initial insurance with your industry or retail fund. Okay, so as I was mentioning before, assessing for accessibility of your superannuation funds, reaching retirement, specific age. There's something called transition to retirement once you're 60 to partially access. Full pension for super pension is at 67, pending when you're born. But as of right now, as of today, for those people who are not yet retired, it's preservation age to 60 when you can start partially accessing it. We talked about the business exception rule as well. And understanding these conditions are critical to avoid penalties and ensure there's long-term fund stability. So that is all for my portion. I'm going to switch over to Simon's slides. And there we go. So thank you for listening in. And Simon, you can take it away. I'll just go through this. I'll go through the slides when you get up to your portion. Okay.
Yep. Thank you. Did you change me over?
Yes, go ahead.
Yeah. So as we were saying, self-managed super funds and super in general comes with a lot of advantages that you may not, or you don't get by investing outside of super. One of the key aspects of superannuation regime in Australia is that it's not as widely known in the Australian sort of population as enforced savings. It's actually incentivized savings. So rather than thinking about it as the government forcing you to save, it's really the government incentivizing you to save for your retirement. So going back to a lot of the rules that we were just discussing, the reason for that is because you're getting these very tax advantaged incentives to make these savings. So by allowing you to access the superannuation to manage it yourself comes with a lot of extra rules to ensure that you keep it within that sole purpose of superannuation and retirement benefits. And that's why you continue to keep the incentivized savings being the very big tax deductions you get. So just as a quick run through, which we've already covered there, so I'll just move to the next slide. We've already sort of covered this one as well. Why choose an SMSF? As we were just saying, SMSF comes with a lot of flexibility. You get much greater control over where your money goes. You must think of superannuation as your money. Don't think of it as just some magic money in the future that you're going to get. It's your money. So you can choose where you invest it. You can choose where you pay your fees to. And when you do that in conjunction with a financial advisor and other professionals, it can result in much greater returns in the future when you get to retirement. As we were also saying, you can tailor the strategies to suit your personal circumstances. Each family always has different nuances in terms of family makeup, intergenerational wealth transfer, all sorts of things like that can be done within your self-managed super fund. Again, working in conjunction with your advisor to achieve the goals that you want for your particular circumstances. We've discussed pooling the resources. We'll jump over here to the contribution. So this is really where we get to the tax incentives. So as you all know, here in Australia, most of us are paying between 30 to 49% tax every year, depending how much we're earning. What you've got to think about and understand with superannuation is that you're capping that tax rate at 15%, both on money going into the fund, as well as earnings on that superannuation investment while it's in the super environment. So you've got a much greater advantage in terms of increasing that savings pool because you're paying, in some circumstances, up to 30% less tax than you would be if you were trying to save that same amount of money outside of super. So again, working with your advisors, you can work to, when you're looking at building a long-term savings goal, mainly being obviously your retirement, you can structure the right investments to be within that structure to have the best, possible return on investment at the end of that period. You've got many ways to get that money in there, being both, as we've got here, concessional contributions, which is contributions that you're either paying directly from your employer, being your superannuation guarantee payments. You can choose to do additional salary sacrifice contributions and also direct personal concessional contributions up to your maximum caps for the financial year. There's a few different nuances around those caps and what we can do with them. There's some good clawback options for catching up from prior year contribution caps that you haven't missed. So again, talk to your advisors about that. And then you've got options for after-tax contributions. So when you've got, say, a chunk of money sitting in your bank account, or you get an inheritance from family, and you want to sort of structure your investments, there's options there as well to move some of that into your super environment so that it has the best tax outcomes. Again, lots of these come with rules and caps. Work with your advisors to work on doing it in the best way possible. Tax advantage growth. So again, I'm going to harp on this today. It's really about the tax advantage. So you can you're capping your tax at 15% within superannuation. So that's all your contributions going in, the earnings on that, and capital gains is also included in that. The even better advantage you have is if with proper planning and foresight on your longer term investment options, say for example you're purchasing a property or some other large investment, or even just your standard listed share portfolios and managed funds that we were talking about earlier, you can time especially for your bigger chunkier assets, the sale of those assets to a point in time when they actually can realize a 0% tax on your capital gain, being obviously timing that after you hit retirement and start pension. I'll give a quick case study of that. I had a client this financial year, I was doing last year's financial accounts for them for their superannuation fund. Husband and wife, 65 was the husband. The wife had turned 60 earlier in the year. They had a big property that they'd had in the prop fund for 10 years or so. Put it on the market, sold it in April of that year, realized a very big capital gain that they weren't expecting. While the member that had turned 65 had rolled into a pension, it was only partway through the year. The wife hadn't rolled into pension because she hadn't met a condition of release. However, had they contacted their advisor and discussed it in a little bit more advanced notice and discussed it with someone like myself, we could have helped them structure their personal affairs so that they both met a condition release as at the 1st of July of that year. We could have rolled them both into pension, ensured that they met their minimum pension for that year, and therefore when they sold that property, it would have been a 100% tax-free on any gain. As it was, they ended up with a $30,000 tax bill as opposed to a $0 tax bill. So it's just really trying to emphasize that with the right planning and the right knowledge, you can get some very, very good tax advantages by these types of structures, especially self-managed super fund, because you do have control over when you sell the asset. Retail funds and industry funds, you have no control over when things are bought and sold because it's managed by the trustee. Self-managed super fund, you can time it exactly however you want. Which
do you want to touch on the franking credits there, Simon?
Yeah, so the other thing as well is that franking credits can be quite good for self-managed super funds, not only in the pension phase, but also in the lead up in your accumulation phase. They can be used in addition to the tax incentives you're already getting there to offset your existing tax liabilities that you'll be accruing throughout the year on your contributions and other earnings. Again, working with an advisor to structure your portfolios properly, to have those investments in your portfolio to get those franking credits is something you need to talk about. All of this comes down to this second last point, the tax effective compound growth. It's all good and well to have a savings plan and an investment plan, but if a lot of that's being eaten up by taxes, like in the environment outside of super, as opposed to inside of super, and you compare the two, you've got that opportunity over that, the period of your working career to really cash in on some of these incentives that are there with those investment and savings goals. What do we got? Tax-free. So we've just discussed, so tax-free in retirement, in Australia at the moment, if once you turn 60 and you meet a condition of release and you start a retirement phase pension, any income that's allocated to that portion of the member balance within the fund becomes tax-free. Again, it's very good for self-managed super funds to do that, because you can structure the portions of that fund, especially if you're a husband and wife and you're roughly the same age, to have the entire fund being tax-free, or as much as tax-free as you can get within the caps that we've now got, 1.6 million being the net, well, higher than that now, but the caps that we have to get as much of the fund tax-free as possible, so that, you know, your income is effectively at that tax-free rate. There is rules and caps and nuances to that. So again, speak with your advisor. And the very last thing that a lot of people overlook is the estate plan. I just want to jump back to that last one. Is the estate planning advantages. A lot of people forget that on death in Australia, you pass on your wealth that you've accumulated to your children. Depending on the environment and the way you've saved that and where it's sitting, they could be hit with a fairly hefty tax bill just for the benefit of receiving their assets you've passed on to them. With the proper planning within superannuation, and especially self-managed super fund, you have the options and the ability to minimize the amount of tax that will be hit on that transfer of wealth. Again, speak with your advisors about that. It's one of those things you need to plan for well in advance. You can't just do it a month before you feel like it might be your time. It's too late by then. You've got to really have it planned and put in motion many years ahead. Yep, so we just jump ahead. What do we got? So again, going back to a lot of the rules that Lopeye was discussing, with this great power being the tax incentives you're getting, the reason you're getting those is because it's there specifically for you to save for your retirement. And that's basically the sole purpose of self-managed super fund. You'll hear that word repeated over and over again, sole purpose. It must be for the sole purpose of retirement. So anytime you go to do something in your super fund, once you've set up the self-managed super fund, ask yourself, is this for the sole purpose of my retirement? Am I trying to get some sort of present day benefit from that? If your answer to that is yes, then the most likely answer is that no, you're not allowed to do that. By working with professionals such as myself and Lopeye and others in the industry, we will help guide you through those rule sets to keep everything compliant and, you know, get as much done as you can. But really, it all comes down to that sole purpose test, because again, this whole superannuation regime is all about saving for your retirement, so that when you retire, you've got an income stream there that can support you in your retirement. Because of that, your self-managed super fund is obliged to prepare financial statements each financial year, prepare an annual tax return, and on top of that, have an annual independent audit completed by an SMSF auditor. Again, firms like myself specialize in doing all that. We prepare the financials, we liaise with the clients and the advisors to ensure that everything's documented correctly. We liaise with the auditors and provide them the documentation and information they need to be able to sign off on that audit to say, yes, you've done everything you need to. So again, speak with your professionals about that, because, you know, there's lots of advantages here, but also, you know, lots of obligations as well. And, you know, while the name does imply self-managed, that you can do it yourself, and I mean, there's nothing to stop you, but it's not an easy task if you don't know what you're doing. So, and that's where professionals as myself come into the picture. So if there's something here that you're interested in, feel free to reach out to any of us afterwards, and we can help you through your questions. And is that the first one? Oh, yeah.
Right, so I will switch over. Before I switch over to my wife, just real quick, Simon, maybe we could just touch on the penalties of non-compliance. So for example, when people do the wrong thing with SMSF, ATO, in conjunction with ASIC, do provide people what you call contraventions that the accountants will submit to the ATO. And then those penalties can range with making them do some things, making them do courses to brush up on their knowledge, but also it can come with penalties and fees from all the way up to being 50% of the balance of the fund, which is obviously not a great thing. Anything you want to touch on that, Simon?
I mean, yeah, absolutely. There's penalties there. I mean, you know, the ATO is generally pretty good at working with trustees to ensure, like, when mistakes are made, mostly it's honest mistakes, and it's just like, yep, please fix that up, maybe do some education. But there are very hefty penalties, as we were saying, that everything, you are the trustee, so you got to remember that everything comes back to you with the decision making of the fund. So you need to be aware of that. And the penalties can be quite big. There's fines that can be issued not just to the assets of the fund, but to you personally. And you know, if you get really, really up there, there's some other hefty fines that, yeah, we can discuss it other times. But yeah, follow the rules and you'll be good.
Absolutely. So just switch over slides to the new one. It's following there. I'll unmute.
Hi, everybody. Thank you so much for joining this webinar, just to add some value and give some information about SMSF. So my name is Modupe Oyekanmi, and I'm a mortgage broker with GTM Finance. And I'll touch base about the finance aspects if you're looking at as a property asset class in your SMSF. And how mortgage brokers can also assist in that process. Next slide, please. Beautiful. As a mortgage broker, where we really come in is we assist to determine, look at your personal financial profile, look at your super fund balance, that's the SMSF balance, and identify what sort of loan products would fit the investment you're looking to purchase. I mean, the property investment you're looking to purchase. Because every lender does have different policies, and depending on what sort of LVR you're looking at, that's the loan to value ratio, what sort of property you're looking to purchase, the postcode you're looking to purchase. Those lenders do have their policies. And what we assist with is direct you on the lenders that would fit what exactly you're looking for. Next slide, please. Great. As Simon mentioned, some of the benefits of SMSF lending is the tax advantages, leveraging to grow your wealth, the diversification which property investments do come into your SMSF portfolio. And when you're thinking of retirement, that's a great retirement wealth creation. That's depending on the strategies you have. And that's why it's very important to have professionals you're working with, like a financial advisor, having an SMSF specialist, just to create a really good strategy, and that will just sort of help you through your journey with having a self-managed super fund. And next slide, please. This is where it gets fun. And when clients come across to me, maybe they're looking to set up a self-managed super fund, or they've already set up a self-managed super fund. We do discuss the criteria. What sort of properties are we looking at? What exactly does the bank want to know? First of all, if you're looking to set up a self-managed super fund, let's say you have the thoughts, you've spoken with a financial advisor, or you're working with a self-managed super fund specialist, we are able to secure a pre-approval for you, depending on what phase you're in. If you have set up a self-managed super fund, or you do have an existing self-managed super fund structure, the bank wants to know that you're actually compliant and have your investment strategies in place. And some of these criteria they look at is the minimum deposits. They look at deposit between 10% to 20% to 30% deposit, which is required. And as you would know, with the normal resi loan lending, the more your deposits, the more competitive your interest rate could be, and the more negotiations you could have in place. So some lenders could borrow you as much as 90% of the value of the property, and some would only borrow you 80% or 70%, just depending on what sort of lenders it is. Lenders do have loan to value ratio, depending on what sort of property you're looking to purchase. Say, for example, you're looking to purchase a commercial property, or you're looking to purchase a rooming property, maybe a boarding house. The restrictions and the policies guarding a commercial property and a boarding property, a boarding house, is quite different. So it just really depends on that sort of things you're looking to purchase in your super fund that the bank would, it just really depends on those sort of properties you're looking at. Another criteria we look at is ensuring that there's sufficient fund liquidity for loan servicing. So depending on the lender you're looking to proceed with, or depending on what's the amount you have in your self-managed super fund, the bank would want to make sure you do have 10% of either the property value or the cash accounts remaining in your accounts after the purchase of the property. So what that really means is, after taking your deposit of maybe 10% or 20%, stamp duty, the advisor fees, and other fees, there should be a 10% of either the cash management account or 10% of the property value remaining in the self-managed super fund account. This just allows for, in case the property is not is vacant, or maybe something comes up, or you lose your job, you're unable to get contributions as a self-employed person. So that's why the bank allows that liquidity in place for your self-managed super fund. The lender also looks at your contributions from your employer. So they would assess a PAYG differently to the way they would assess a self-employed. It just depends on how long the person is being employed for, or how long the person has been running their business for. And the sort of properties that are allowed are residential properties, commercial properties, and of course, just like residential lending, the restriction does apply because it depends on the postcode you're looking at. It depends on what sort of residential properties or commercial properties you're looking to purchase. And of course, Lopeye and Simon mentioned, usually the bank would not allow you to purchase a property that you are going to live in your self-managed super fund. So that's just something to bear in mind. This is what the SMSF lending process looks like. If you're thinking at the phase of purchase, setting up a self-managed super fund, or you do have one already, we will assess how much exactly do you have in the account, see what sort of property you're looking to purchase, ensure that you have sufficient borrowing capacity to borrow that loan from the bank. We're able to secure you a self-managed super fund loan pre-approval, even before you establish the SMSF, or maybe in the process of establishing the self-managed super fund. Afterwards, the bear trust is being set up either by your SMSF specialist, or it could be set up by the bank. Not all banks does it, but few banks would do that. Then you would go identify the investment property you're looking to purchase, depending on the pre-approval. So of course, if you're getting a pre-approval for a $700,000 property, you wouldn't be buying a $750K property. You would have to buy something lower than that, just depending on what the borrowing capacity is like. Then we proceed to purchasing the property, finalizing the loan, working with the legal team and the specialist as well. And post-settlement, you have your ongoing compliance, you have the loan repayment. And the positive things that does happen is yearly, we do a loan check just to see where you're sitting at, to ensure that your interest rates and your loan setup still meets your current investment goals. I'll just touch base a little bit on the Bear Trust. So a Bear Trust is set up to hold the property on behalf of the SMSF while the loan is being repaid. And the purpose of this is just that it separates the property's legal ownership from your SMSF direct title. And it ensures alignment with the lender's requirements and the regulatory standards. And this could also be set up by either your SMSF specialist, or it could be set up by the bank. Not all banks will do that. Very few banks will. Regarding interest rate for self-managed super fund loans, there is quite a bit of a difference, which we see about 1 to 2% higher than residential loans. And of course, it really depends on how much you're borrowing from the bank. So the more your deposits, the more negotiable we could be in terms of the rates. And, the sharper the rates, the more the deposit, the sharper the rates could be. And the higher interest rates could really impact on the loan repayments. And overall, you can imagine in a circumstance whereby you're unable to get a tenant in the house, or maybe the person loses their job, they're unable to work, there could be an impact on cash flow in that sort of, area. And with the interest rate as well, it's always great to plan your cash flow. We always calculate the borrowing capacity based on worst case scenario and best case scenario, just so we can accommodate the cash flow and the higher interest rates and maintain profitability as well. And next slide, please. Thank you. The common mistakes I do come across with the clients I speak with on a day-to-day basis is, number one, is not having enough liquidity. And this is where working with professionals come into place, like working with your financial advisor, ensuring that you actually have enough liquidity, you have enough cash in there for unexpected costs. Like I've seen some people where they set up their self-managed super fund. Property is just an asset class. They might diversify into other things as well. So we just want to make sure there is that liquidity there in case things do happen in future. Also, choosing the wrong property. Just making sure it aligns with your investment strategy. If, let's say, you want to double your property, maybe in a couple of years, there are some properties you wouldn't want to look at, and there are some properties you would actually want to focus on. Because I've come across a client who purchased a 250K unit, and in 2 years' time, the property actually went down instead of going up. And a common mistake I also have noticed is the non-compliance with ATO regulations, which Simon has actually discussed about. After settlement, it is great to check in and make sure you're compliant, because if you're to purchase another property, the bank wants to ensure that all those taxes you haven't done, you have to catch up with it, and you actually have to be compliant to purchase another property. Also, ignoring exit strategies. So if, let's say, you're setting up a self-managed super fund with a friend, with a business partner, even your partner, some banks might want to see the exit strategy. Maybe if you're 60-year-old or you're 65, or you're at the stage whereby they want to know what's going to happen if you retire, if you're setting it up with a friend, if one person wants to leave or they pass away or something, what exactly do you want to do? So they might want to see the exit strategies in place. So it's just always good to make sure those boxes are ticked. And good. Next slide, please. In self-managed super fund, another difference between the self-managed super fund loan and the residential loans is there is no cross-collateralization. So you can't take equity from an existing property to purchase another property. So that does not happen in SMSF. And in terms of the repayments, you must actually pay down each loan individually, say for a new deposit for another purchase. So you can't, like I mentioned, you can't just take, this property has a lot of equity in it, let me pull it out, like I would do with my resi loans to buy another property. That does not happen in self-managed super fund loans. And another thing to also mention is if you're looking to build, the bank doesn't do they don't do progress payments like they would do for residential loans. So they just do a one-part contract whereby you pay deposits at the beginning and at the end, the bank settles on the loan. Next slide, please. Here's this case study here of a client I worked with recently. Matt and Anu, both in their early 40s, they wanted to diversify their self-managed superannuation portfolio after speaking with their financial advisor. They had a super fund balance of 250K, and they were looking to purchase a property around 765,000 by getting an SMSF loan. What we did was we were able to get a loan of 612,000 at 80% LVR. Of course, they had the 10% retained in the SMSF based on the cash balance of the cash account. And they contributed 156,000 from their SMSF as a deposit. Stamp duty was also paid out of the cash management account. They purchased the residential property with a tenant paying $600 per week in rental income, and the rental income covered the loan repayment and additional super contributions that helped them pay off the loan faster. Because if you have any questions for us, we can take the questions at the end of this. Thank you so much.
Fantastic. Thanks for that. And also thank you, Simon, for assisting with that. One thing I wanted to touch on is in regards to the, I saw it over here, the cash flows. So one of the questions that we actually received, the first one from Tunde, was a great question. He did ask, in regard to funding your SMSF, is there a commitment to fund it at a fixed schedule, or can you just fund it when convenient for you? So I believe he's trying to ask in regards to contributions to the fund. So once you've transferred or rolled over your superannuation fund from your industry or retail fund to an SMSF, you have the option for your employer to now make their contributions into your SMSF cash account. So someone who's on $100,000, as of July 1st, there will be a 12% super guarantee from your employers, which means that individual will be getting $12,000 a year in their super or $1,000 a month. That $1,000 a month is now going into your super fund, which is helping pay down the loan, or likewise invest in other assets the same way it would be able to be invested within how it's been invested in your industry or retail fund. Also, quickly touching on what Simon mentioned earlier in the super transfer balance cap, it has increased to $2 million now. So essentially what that means is while we're working, we are all paying 15% tax. Once we get to retirement, that taxes on income and growth, capital growth goes to zero, right? So if you've got $1 million, one partner has 1 million and the spouse has another million, making 2 million, and that is receiving 5% in income distributions from either dividends or from rental income, that is going to be, like I said, $2 million. 5% of $2 million is $100,000. That $100,000 is tax-free, right? Whereas if that same $2 million was invested outside of superannuation, that $100,000 worth of income that you receive, 5% of 2 million, would be actually taxed at your marginal tax rate, which from $45,000 to $135,000 is taxed at 30%. So 30% on that 60 or so $1,000, right, is $18,000 of tax, which you paid zero for just because the same investment was in the structure of super versus the structure of outside, right? So these really, really great advantages that people are going to be able to receive once from a tax perspective if they focus and they grow their superannuation well. What I just explained then in regards to the tax advantages is not just for Self-managed super fund, that is the same tax treatment for all other superannuation funds. So superannuation funds certainly are one of the best tax, I guess, optimized structures that we have available to us in Australia. Okay, we have a few more questions. I guess I haven't unmuted everyone yet, so I will unmute for people to be able to ask questions, but I'm going from the top. We have David's asked, what's the best strategy to build a portfolio in the super? Pay interest only, save more money for the next one? That's totally dependent on the person's investment strategy or belief. Some people would say they want to buy as many property as they want. Some other people would say they only want one or two, because don't forget, at current interest rates, for the most part, even with a 20% deposit, you are negatively geared, right? So you are actually losing money cash flow. It's costing you $10,000 to $20,000 a year. So a misconception a lot of people have is that they think that if a property is negatively geared and they get to offset it on their income, which is not available in super, right? You can only negative gear outside of super. You can only carry on the loss within super. Then they're going to make that money back up from the capital growth the property has. But let's look at Perth, for example. Perth has not gone up, did not go up in value from 2012 to 2022. So somebody who invested in Perth any of those years and is losing $10,000 a year, if it didn't go up and they sold any time between 2012 to 2022, they're selling at a loss and they don't get to recapture all of the loss that they made on the negative cash flow they received on the property. So hopefully that helps you with your question, David. TA, what is recommended minimum super balance to start at SMSF? I know I'm speaking a lot, but I'll just quickly answer that one too. It's fairly basic it depends on what you're looking to invest. Historically, ATO used to recommend around 200 to 50,000 balance. However, now since the compliance and the technology has greatly increased, someone may start a fund up with as little as $100,000, depending on what they're looking to invest. If they don't have a specific investments they're looking for, then they may want to have a higher balance. But again, people's circumstances are different. I know some people have done fairly well in some riskier investments that they did with their super, hence it made sense for them. How, in case of four different people with different super funds come together, SMSF, how is the movement of the funds work within SMSF? I'll leave that one to Simon because I've answered, a few back to back. Go ahead, Simon.
Yeah, so combining a balance with 4 people, I mean, as we sort of mentioned before, if you generally want it within the same family group, but it's very simple. It comes into the fund, and this is where firms like myself come into play, is we have specific accounting software that's specialized for self-managed super, and we track your member balances within the fund and allocate the relevant earnings from the investments that you make across those member balances. Very similar to your current retail or corporate funds, you'll get a member statement at the end of the year. So part of the documents that will be in your financial statements that are prepared by us will be an individual member statement for each member that shows, their opening balance, their contributions, taxes, and other expenses that apply to those members specifically, but also their portion of the earnings or losses that have resulted from their investments within the fund. There's a few nuances, like ways we can treat it. Mostly the most standard way is just have everyone is pooled and they get a portion of the earnings based on their member balance. But there is the possibility to use segregated asset investments if you have, say, a fund like that with 4 members, and say 1 or 2 of them want to be in one specific or very high risk asset class, but the other 2 don't. We can actually segregate specific assets to specific members as well. So, yeah, it's a little bit more nuanced, but that's it in a nutshell.
Thank you. KB asks for the minimum you cannot leave in your industry fund. Each industry fund and retail fund will have a minimum balance that they require. Usually it's $6,000 to retain insurance, but keep in mind you're going to be having fees from both the SMSF and the industry fund. In regards to your question in regards to owning a company, being the ownership for parent entity for something like a business, that's a quite specific questions. Hence, please reach out for us to go through those details. Again, this is just general information, cannot be professional advice. Satwinder asks how to structure the partnership actually. That again is depending on what type of investment you're considering, who's trying to be invested in it, etc. That is a specific question. Feel free to reach out to us individually to discuss that. David has asked, during the first 10 financial years, it's negatively geared. Can it compensate the loss once it's positive, even after 10 years? To my understanding, there's no time frame on carrying over losses. Simon, is that correct?
Yeah, carried forward realized losses. If you're talking about recouping the tax losses from year to year, it's kind of a different story. But yeah, I mean.
So I mean, like, as far as if your losses, he's asking is, let's say, $10,000 a year from just the lack of rental income due to the loan, would that loss be offset from when the loan gets lower and there's more income from
no, different accounts. So we're talking losses from a realized loss point of view. So you're talking about your capital gain. The realized loss can offset against your capital gains, and that can carry forward.
Yep.
But if you're talking about income losses from year to year, no, that doesn't carry forward.
So essentially, if you're at a loss of $10,000 per year, and the next year your gain of $10,000, that's just a new $10,000. The $10,000 you're a loss of is being wiped off, right?
Right. Yeah.
Good. Thanks for that. Menasek's question is, what are some differences between holding assets in a family trust and SMSF, aside from when you can access a fund? That again is quite a specific question, so we'll take that one offline. Next one from Association: how can one set up a property if couple already have a combined SMSF and a property under it? How can they save up for one? Okay. Another property, so essentially it would just be from more contributions going in from employers for the most part. That's one way they can save up for another property. It's usually from contributions that's going into the fund, is the same way that you're able to get a deposit for the first fund. And yeah, that was the last question. I have allowed everyone to be unmuted, so if we can take another one or two, because we are now pretty much going on 8 p.m. So either type in or unmute and ask another. We'll take another 2 questions, or if not, we will finish up for the evening. Okay, I think those are all very good, comprehensive questions, and it's good that you're all thinking about it. And yeah, I just want to emphasize again in regards to those advantages long term. If somebody gets any asset, or let's say even residential property, buy at 750, you sell at 1.5 million, and you're retired, and you meet the condition of release or get to pension age, that potentially now can be a realized asset that someone may not pay tax on. So depending on the circumstances, but those are the huge types of gains, since it's a leverage asset that people may be able to get from that capital increase over time. And let's see, cost of the last question I'll answer is this: what is the cost for the setup and ongoing cost of the SMSF? So establishment costs, actually I'll leave Simon to answer this one because he does that with his firm. Go ahead, Simon.
Yeah, so establishment costs can vary from provider to provider. Our firm does them for $1,375, which includes setting up with the corporate trustee. The most standard way of doing SMSFs these days is with a corporate trustee as opposed to individual. It can be cheaper to set it up with an individual trustees, but there's just reasons why we don't recommend that much anymore. The savings you get by not setting up a corporate trustee are kind of outweighed by the complexities it creates for you later down the track. So yeah, so I mean, there's lots of providers out there. Prices range, but yeah, there's our fees.
Excellent. So yeah, the establishment costs, it also includes, you have your ongoing return costs from the accountant, which can range, anywhere from 1,200 common amounts on the low end all the way up to 3,000, usually depending on the complexity of the fund. And then the auditor that audits the returns, that also can range anywhere. Low end we're seeing is low 300s, and that can go, you know, up to $500-600 per year as well. If you are buying property, commercial or retail or residential, prior, you could do a valuation every 2 to 3 years. The government's updated that now evaluation does need to be done annually. So that is another cost that people need to understand. Just I had a question on how people can reach out to us for our contact details. On this page, I've got all of us presenters' names, phone numbers, and email addresses. You can also connect with us on LinkedIn as well. We're on LinkedIn. And yeah, feel free to reach out. I've sent you emails for this event, and we will be happy to answer